Okay, so the Federal Reserve on May 4th just raised the Fed funds rate by 0.5%. Okay, so what is the Fed funds rate? The Fed funds rate is basically the interest rate where that banks lend to one another. Like banks are always borrowing and lending with each other, and that's that the Fed funds rate is that particular rate which they're borrowing amongst each other. Now that does not mean that's the specific interest rate that you are receiving on your bank money or the interest rate that when you borrow that you're getting, but the Fed funds rate does affect borrowing and savings. So let's have a look at how it affects when you borrow money and how it affects when you save money. And to note, they raised it by 0.5% on May 4th. That was the largest single increase in over 20 years. And they've made it clear that they do want to continue to raise interest rates to fight inflation. So in a rising interest rate environment, what are the implications for you as a consumer? Well, it's going to cost more to borrow to buy stuff. So if you're, borrowing money to go buy a house or a car or whatever, if you're starting a business and you're borrowing money to buy a business, it's going to be more expensive because interest rates are higher. The other thing that it does is if you own like a variable interest rate on your credit card, or your credit card has a variable interest rate, it's going to adjust higher as interest rates go up. So you're going to notice your monthly minimum payments are increasing, and that's no good. So what can you do in terms of your debt during this time? Well, I just want to encourage you, try and pay off your debt aggressively. Also, if you have a variable interest rate loan on your credit card, get that thing paid off. Once you get those credit cards paid off, cut them up if you can. Be courageous. So that's one thing you can do in a rising interest rate environment is try and pay down your debt aggressively. So the good side of all of this is that potentially, it's not guaranteed, your interest rates that you're receiving at the bank, those might be going up. So again, banks aren't mandated to raise their interest that they're paying you as a consumer, but inevitably, when the Fed raises rates, there tends to be this correlation with banks as well, where they start to raise the interest that they're paying you when you just have money sitting in the bank, your savings or money markets, etc. CD rates, certificates of deposits, those may go higher as well. So one thing you'll want to do is maybe shop around. You could look at different banks and see what they're paying, because they're going to be in competition with each other, maybe raising the rate to receive more deposits from consumers. So the Federal Reserve they use these tools to fight inflation and do things, and when they're raising interest rates, it's bad for borrowing, but it potentially is good for money that's sitting in a savings account. So hope this was helpful for today, and we'll see you next time.